Welcome back. As mentioned on channel, there's obviously a change of strategy coming from income shares. It's raised a lot of questions in the community around the puts. I know a lot of people are nervous about them based on what we've seen with the zero DTEs. I kind of want to put people a little bit at rest with it. The current strategy that they're deploying is 70%. They'll keep 25% in the underlying. They'll create the rest in put options. So they do have a lot of flexibility. So they can go 10% in the money or 10% out of the money on every stock. They can run dailies, weeklies, monthlies against any of the stocks. So I just want people to just know that there is a lot more flexibility in the prospectus. They are saying they'll be more actively managed. We will track this. We will keep them honest like we did before to see how they perform. They've apparently back tested this strategy and it's performed well. They've done their homework apparently this time. So let's see whether that ends up being the case. Obviously, I hope it does. But it obviously, I do want to go into a bit more detail. I did do a high level overview of, calls and puts, but I just want to spend a bit more time in a video today doing that just to give people a bit more explanation around out the money, at the money, in the money, the moneyness side of things, just a little bit more, just so that people can kind of get a feel again around how all this stuff works. There are two sides to an option. So just as a kind of reminder, at its core, an option is a contract giving the right, not the obligation, to buy or sell an asset at a set price. This comes in typically two formats: a call option, which is what we were writing before when it came to income shares, which gives you the right to buy. You profit if the stock price goes up above your strike price. Now, this is the most common way that options are run in funds is calls. And we also see it when people do it themselves. They normally own 100 shares of Apple or whatever it happens to be. And then they write a call option. They need 100 shares because that's one contract. And then they'll write a call option on that. A put option is where gives you the right to sell your profit if the stock price goes down below your strike price. So it's basically the inverse of the call. So understanding the moneyness. Now, moneyness just simply means it's the options relationship between its strike price and the stock's current market price. Okay. The delta in effect. It tells you if the options will be profitable, if they were exercised literally right now. For call options, you want the price to go up to your strike price. And then we'll look at, it's a bullish strategy ultimately. So if we look at the options that we have, in the money is where the strike price is less than the market price. So an example of that is if a stock was 105, the strike would be, so basically less. The money is where they're equal, very simple, $100 and your strike is $100. Out of the money is where the strike price is greater than the market price. So this is where the stock might be 95 and your strike may be 100. Okay. And most of the time you would start off out the money. Okay. For a call option. In the case of a put option, it's the inverse. So in the money is the strike price greater than the market price. Here, the stock price would be $95 and the strike price would be $100. The money stays the same on both sides. The out of the money is where the strike price is less than the market price. So the stock price is 105 and the strike is 100. Okay. So sometimes people talk about this being the mirror image rule, where it's the inverse relationship. If a call option's in the money at a certain strike price, put option with the same strike price would be out of the money and vice versa. So remember, when you're looking at any options chain, and again, we will cover an option chain, a real one at some point, you will see there'll be the call side and the put side. And there will sometimes be a ratio. Normally it's fairly balanced. Sometimes it can skew in a particular direction. if a particular stock is in a bearish or bullish direction. So deconstructing the option premium itself now, as the price that you pay for an option is called the premium. It's made of two distinct parts. It's the intrinsic value and the time value. So the intrinsic value, which is one component, this is the option's real value. So the profit you make if you exercised it immediately, so it can never be less than zero, in effect. Okay. Out of the money and at the money options have zero intrinsic value. So this is why when we were running the calls currently, that's why we were not looking at the intrinsic value. Okay. So when we look at the time value part, this is the speculative part of the premium. So obviously this is where we don't know what's going to happen because the market can constantly move. What will happen is that as you get closer to the expiry of that option, there is less time, and that is not like linear exponential, as you can see on the chart right now. You can kind of see this constant rapid decline as you get to expiration. Okay. So once we get closer to the end date of the expiry, there is a lot more known factors and there's less chance of people being able to buy and sell as that window gets closer. And there's less uncertainty as you get closer to anything within time. So obviously the only time that might differ is maybe options where you've got a earnings report that's coming out that week and you're happening to buy in that same week that the earnings are coming. So if you're running weekly options, let's say, then the vol might be slightly higher and therefore, that decay may be slightly different. Now that decay, as we've talked about in the Greeks video, is referred to as the theta decay. Okay, so that's the time decay. So as we approach expiry, that decay accelerates, the eroding of the options, the value basically reaches zero at expiry, so it has no value. So when we look at that option premium, your option premium is calculated the point that you raise the contract. Now, this is really important. What people think is that, as it gets closer, this is what a lot of people were feeling when we were doing income shares. But now, the contract's worth a lot more because it's gone up. It doesn't work that way, unfortunately. You've taken that shot at the time that you've opened up the contract. So you get paid that premium instantly, the point you raise the contract. Now, there are some advantages to that, obviously, because, you don't have to wait until the end of the week or end of the month to collect those premiums. They are given to you straight away the minute you open that contract. The obvious thing here is the gambling aspect of the time value, which is you could have earned more or you could have potentially got less if you were to have waited. And this is why you'll find that the premiums change as you get a shorter time window, which is why the zero DTs, a lot more aggressive. So is the weeklies over a monthly. If you imagine, if you've got a month to take out the volatility, yes, you're going to make less premiums because there's less volatility, but you've got more certainty there. And therefore the premium will be slightly lower for the less risk that you're taking in that sense. So again, that's just something to mention. As I said, with the intrinsic value, this is where, the market price might be 105, your strike price is 100. So there is a $5 intrinsic value already because there's already $5 there because we're below the market price. So there's already that $5. So let's say we had an options time premium value of $2, an intrinsic of $5, then you get $7 in premium. Okay. So that's just an example. In terms of the premium composition, as I said, the mix of the intrinsic, the time value changes drastically depending on the options moneyness. So the chart below tries to visualize the premium breakdown from a hypothesis perspective. So, if you're deep out of the money and there's a time value of 1.5, and then you have a time value at the money of 8, then your total deep in the money option is worth 20. The one thing you need to kind of remember is that when it comes to out of the money, it's purely just time. Whereas in the money, you're getting both the intrinsic and the time element value involved. So when we talk about income shares raising this new strategy with in the money, the reason why they think they're going to get more premiums now from a total premiums perspective is because they're also taking the intrinsic value along with the time value element. Now, that's obviously a risk because a stock can still obviously go up or down. But that's why they believe that this will be a strategy that will ultimately earn them more premium. Whether that plays out correctly, we'll see. And it obviously depends on how far deep in the money they choose to go. We don't know that number yet. We also don't know the impact of if they were to get assigned, would they do what they were doing with the calls? So in the previous calls, we'd have to give up the shares. Now it's the inverse situation. We would have cash secured put. So we would have the cash in the fund. If we were to get assigned, we would have to take those shares and bring them into our pot. Now, we could just pay that and not take the shares. Again, this is part of the decision making the fund will have to do. Now, I think where it gets interesting is what will they do with the existing funds? Because obviously some of them are more, obviously all of them are more weighted than 25%. So will they just keep growing that and then write call options until they go down to that ratio? So I guess I'm asking the question whether they'll do the wheel strategy or not. Again, that's not clearly defined anywhere. If you want to know more about the wheel strategy, I talk about that in another one of the videos, the earlier videos. But I think that's an option for them. Again, we don't know how they're going to run that. And again, we don't know how often they're going to flex this strategy. We know for the commodities that they have hinted to us that they're going to keep it 3% and they're going to keep the out of the money calls for those because they're obviously performing quite well. And typically, gold is pretty much on an upward trend over the long term. And calls are a bullish strategy. So I think it makes sense. So we'll see what happens there around it. The zero DTs, I do not believe they're changing the strategy because they are going to release some weeklies in the future around those. So again, I don't think anything's going to change there. So it'll be probably the single stoppers where they'll do it. Obviously, the impacts we'll have to see from a data perspective, but hopefully that kind of gives you some idea of the fact that the difference here is we are getting assigned the shares rather than giving away the shares because we've got the cash and then we get allocated. Obviously, with the zero DTs, we never did because zero DTs were always settled cash. Okay. I just wanted to kind of give a bit of a kind of working example that you can kind of play around with. And maybe I'll post this on the website somewhere that people can just play around with it and just helps with learning, I think. Okay. I just want to talk about American versus European options. It doesn't mean where the options are being raised in Europe or America. I've always hated that wording. I wish we'd had some other kind of wording, but the terms American and European refer to when an option can actually be exercised. So it had nothing to do with geographic trading location. The distinction is just impacts the flexibility and the pricing. So a American style option can be exercised anytime up to and including the expiry date. So most stock and ETF options are the American style. This offers greater flexibility to capture the profits or manage the risk early. I can take all my profit, and then if I decide to close my position, so let's say it's gone through my strike price and I'm never worried it's going to go a bit too far, I could close that position out and just pay the delta back to close out my contract. So this could be more valuable due to like early exercise, as I said there, potential, especially for puts or calls with. Also, upcoming dividends, some people like to kind of close it early for that reason as well. Okay. A European style option can only be exercised on expiry. Many index options, a European style, it basically eliminates the risk of early assignment for an option seller. less flexible, obviously, than the American options, and generally results in lower premiums, with all else equal. So just some terminologies to understand, and just a brief overview of the differences there. Okay. Understanding options assignments from the seller's obligation. So when the funds are brought out, we're the seller, and when an option buyer kind of exercises their right, a corresponding option seller is then assigned the obligation to basically fulfill that contract. The process is basically managed by a clearinghouse, like an options clearing corporation in the US. So a call options assignment from a seller's perspective, if you've sold a call option and it's assigned, you're obliged to basically sell the underlying shares at the strike price. You receive the cash for selling the shares. If you don't own the shares, you have to buy them at market price, potentially higher, to fulfill that obligation. So this is a little bit when we talk about naked calls and poor man's covered calls and things like that, but that's a video for another day. In income shares, funds like QILD, they do actually own the physical underlying. In the put option strategy, if you're sold a put option and it's assigned, you're obligated to buy the underlying shares at that price. You pay cash for buying the shares. So this happens if the stock price drops below your strike price. Okay, so so let's say the stock price was 100, you wrote a strike price at 95, you'd be obliged to buy it at 95, which may be a good thing, may be a bad thing. Okay, so the key points to kind of understand from an assignment perspective is an assignment typically occurs when options are in the money. For American style options, assignment can happen anytime prior to expiration. For European style options, assignments can only happen at expiration. The OCC uses kind of a random process to assign it and to broker firms and clients. And anyways, a lot of stuff that goes on in the background from exchange of contracts. It's just not a one-to-one. It could be split out. An option seller, you basically keep the premium received regardless of the assignment, but the obligation can result in significant, obviously, financial impact. And we've seen that with some of these funds and some of the erosion in some of these funds. Okay, let's look at the strategic takeaways, the risks versus the rewards, just as a kind of a bit of a wrap up. Moneyness, in the money, the cost highest, a risk profile, lower risk, higher upfront cost. That's the kind of high probability strategies, placing stock ownership. At the money, cost is kind of moderate, balanced risk reward ratio, betting on the directional moves, and high sensitivity to volatility, because obviously you're at the money. Out the money, which is the previous strategy that we ran, cost was the lowest. It was the highest risk potential for high return, but lower cost speculation, leveraging kind of strong market convictions, obviously being a bullish strategy. So, we'll see whether that in the money strategy does actually stabilize the funds, does give us extra premiums, which is what they're thinking it will do because of some of that intrinsic value. But what I think will also happen is we might see a bit more. I'm going to avoid the use the word erosion, but we might see the NAV decline more aggressively because that income has to come out of the NAV in some shape or form. So again, it'll be interesting to see whether keeping that 25% in the underlying helps stabilize the fund a little bit and allows us to capture the full upside of that 25%. Obviously, we still get the full downside irrespective. And if it was to decline, we'd also get assigned, but we'd be assigned at that, obviously at that strike price. So let's see what happens. But I just wanted to give people a clearer picture of, the fact that puts aren't a bad thing. And that they also are a strategy that's used very often. And it's just a mirror inverse of the call strategy. I don't want people to think just because we've moved the puts is a really bad thing. I know there's a lot of misconceptions because of how poor the zero DTEs have done, but I just wanted to give people a general view of it. The other thing I would say with puts, puts is a good way at retail investor for them to get hold of stocks that they believe are overvalued, to get them at a fair price. So it puts, if used in the right way, a bit like calls and every other option strategy, can actually be a positive thing, not a negative thing. Okay, there you go, guys. I really hope this was useful and kind of gave you some insight, or a bit more insight. Put in the comments whether it was helpful or not. Also, let me know if there's stuff you want me to cover that I've not covered. I'm thinking about maybe putting all of these files and keeping the catalog alive so that, people go back and watch these videos. They can also go back and look at these scripts as well later in the future. Maybe I'll add some more calculators in the dashboard and things like that. Let me know what you guys think in the comments, and I'll figure out what to do there. All right. Thanks a lot. I'll catch you on the next one.